everybody. Welcome to Thursday, September 1. We're officially 2/3 of the way through another year, and these years keep running by. So we're gearing up for a busy fall. Fall seems to always be very busy for cannabis. Lots of conferences, MJ BizCon's in November, AICPA Cannabis Conferences in the fall. Actually, it was a little early this year. We just got done with that in August. I was there speaking at that event. I'll be speaking at it next year as well. Next year it will be in Boston, I believe in September. Um, I will be at MJ Unpacked late September in Las Vegas with Ray on my team and some other dope CFOs as well. And just gearing up for a really busy fall. We're still in economic downturn. Last I looked earlier today, stock market's still crashing. Um, if you look at a long-term trend, it's still massively upwards. Um, but we've got the Fed saying they are going to fight inflation, which they should be doing, and increasing interest rates, which generally will cause or expand the recession that many say we're already in right now. And so all that means just the economy is likely to struggle the next period of time. Capital and cannabis is very tight right now as well. And so we will see. Growth. It'd be nice if growth just was always straight up, but it's more like this, up and down and then back up. We are big believers in this industry, both globally and nationally and statewide. And we've seen that over the last 10 years. We got a lot of evidence of where cannabis has come the last 12 years, in any administration, in red states, blue states, whatever. And we expect that will continue. But let's dive in and look at depreciation a little bit and how you can use that. First and foremost, even I get this from non-accountants a lot. How can we plug this or that into cost of goods sold? And I hear from accountants a lot, enough that it scares me because this is kind of accounting 101. You never plug anything into cost of goods sold, really. We put cost either on the P&L or we put costs in the balance sheet into inventory. The only time you ever have cost of goods sold is when you have inventory and it sells. And when that inventory sells, it translates from inventory into cost of goods sold. So you never just shove something into cost of goods sold ever. We see people do it all the time. Cost of goods sold only results, whether we're talking GAAP accounting, tax accounting, you get cost of goods sold when you sell a piece of inventory. That's when you get, and if you sell service, you get cost of service. But again, if you get cost of goods sold, you got to have inventory first. Now let's look at 280, and I'll just plug this into our chat, if I can do that. Let's see. I love to do this one. Way back when, a long time ago, when I was just brand new, a farmer asked me, what the hell do I know about 280E? And I didn't know a ton back then about the whole industry, but I knew enough to say, oh, I know a lot about it. It's only one sentence. And things that are one sentence aren't super hard, and it's written for a kindergartner. Right there, there's just a few key words. No deduction or credit shall be allowed. That's pretty simple. It's pretty easy. It doesn't say most deductions and credits aren't allowed. It says none of them. It's like, great, that's easy, because that means no deductions. That means no credits. None of them. They won't be allowed. And it says if your trade or business. Again, they made that super broad too. They didn't say if your LLC or your C Corp or your multi-entity structure has different cannabis and non-cannabis divisions. It says if your trade or business, that's not a legal term. That is an economic term. If that trade or business is carrying on activities with controlled substances, you're not going to get any deductions or credits in your tax return. And the other key word that I'd finally highlight here, which I do often, is trafficking. What does trafficking mean? That's a very good question. It means different things possibly in the criminal code. For example, delivering drugs. If you never own a drug, if you drive over to the dispensary and pick up cannabis and you drive it over to a customer's house, are you trafficking? In the criminal code, you likely are. In the 280E world, maybe, maybe not. The Champs case has a little bit saying you got to own the pot. So that's still a little bit of a gray area on that. But this is the backdrop, no deduction or credit. So people are like, oh, but what about accelerated depreciation or whatever? Can't we put that in cost of goods sold? No, but what we can do is that's not affected by 280E is 471, and that is not the tax code for cost of goods sold. That is the tax code for inventory. And luckily for our cannabis clients, the tax code says if you have inventory, you can put it on your balance sheet. When it's sold, it becomes cost of goods sold, and that will effectively lower your taxable income because cost of goods sold is not a deduction, it's not a credit, it's a return of capital, and it's only when inventory is sold it becomes cost of goods sold. And so when you think of that, you're like, okay, the more dollars I get in inventory when it's sold, that means cost of goods sold will be bigger. That will lower taxable income. So for the farming cultivators, the chemical processors, the product manufacturers, that includes beverages, foods, edibles, lotions, tinctures, all those big pieces of the vertical, they get to use IRC 47111 for, and you can Google it. That is the rule for inventories of manufacturers, which includes cultivators and processors. And that code is very, very specific. It lists 3 different categories of costs. First of all, it tells you put all of your direct costs, direct materials, direct labor, that goes in inventory. Not cost of goods sold. Again, it goes into inventory. Then what else? You can also put some indirect costs, and there's 3 categories. Category 1 is costs that you must put into inventory, and they're under this section little I. There's little I, two little I's, and 3 little I's. So little I number 1 is indirect costs you must put in inventory. Things like, and they list them: repairs, maintenance, utilities, rent, indirect labor, indirect materials. Then they list a bunch of costs you can never put in inventory: marketing, advertising, selling. I'm going to read this part too because it's going to relate to our depreciation discussion. You can never add depreciation reported for federal tax that is in excess of depreciation reported in the financial reports for GAAP. So you're never going to get 179 or, makers or whatever it is that's on the tax return ever. That's in category 2. Now, the good news is in category 3, it says you can put depreciation reported in your financial reports that are on assets that are incident to and necessary for production, which might include buildings and equipment. But it's just not going to be accelerated depreciation. And oh, by the way, the only time you can ever even put that depreciation in inventory, because it's category 3, is if you're doing GAAP level cost accounting, and if you're doing it in your recurring financials. Your tax preparer cannot come in at the end of the year and calculate this out and add it in. Doesn't work. You got to be doing it month in and month out. You got to be doing good GAAP level cost accounting. You got to have the knowledge and tools to do that. Many of our farms and dispensaries or manufacturers do not have that ability to do that correctly. But if we're doing it correctly, we're going to be able to put some depreciation into inventory. And we can even use some methods that are under GAAP. For example, double declining depreciation is an accelerated form of depreciation, and it is a GAAP approved method for discounting the value of equipment as it ages. And so if it falls into GAAP and we're doing GAAP cost accounting every month, hopefully, that's going to be a lot of support that, yes, we're doing this correctly. That means we can take many of these big category 3 costs, put those into inventory. When that inventory is sold, it will become cost of goods sold. So don't say, I just watched Andrew today and he told me I could put depreciation in cost of goods sold, because I didn't say that. Luckily this is recorded and I can say what I did say, and depreciation can end up being utilized to lower taxable income correctly. It's not a deduction, it's not a credit, but it's a cost that we can add into inventory if we do things right. And it's not actually super simple to do things right on the farm or manufacturer. It takes a lot of work, it takes a lot of tools and work papers. I just updated our cost accounting tools, and that's not even all the tools we need to just do the cost accounting correctly. It's just the tools we need to correct and organize the data. And it's 10 different Excel files and spreadsheets. So it takes a little bit of work and effort. We do it right. We provide a ton of value to our clients. That's why dope CFOs can charge pretty decent fees to their clients, because we're adding a lot of value to these clients as well. So hopefully this helped you if you're looking at that. And then I don't see any questions. I will see you next week. I think I hit everything on depreciation and the only way you can utilize it. All righty. Hope you all have a great week, and we will see you next time.